So, the IRS just announced that they were hiring, and not to help with the millions of unprocessed tax returns or even the millions of delayed tax refunds. The IRS is hiring to increase audits for nearly every income level and certain tax brackets in particular. Your chances of an audit just doubled. So let's talk about it. What's going on, who this affects, and the best way to avoid an audit. No matter how much money you make or how many times you smash the like button for the YouTube algorithm. Okay, so what's going on? The IRS is actively hiring for what they call revenue agents. And these agents specialize in auditing both individuals and business taxpayers across the nation, and will be looking for red flags within tax returns. Basically, anything that looks like tax fraud, like unreported income or deductions you claim but don't qualify for. Now, historically, certain businesses are audited more than others, but the IRS says they're beefing up audits for everyone, including sole proprietors, partnerships, and corporations. You see, for the past 2 years, the IRS has been begging Congress to increase their funding, to do even more hiring, because they lack the personnel needed to carry out complicated audits for very high earners. Then couple that with their trouble with actually hiring, and you can see why the IRS desperately needs more people. And with more people comes more audits. So if you're watching, who does this affect? Well, in short, it affects nearly every taxpayer. Look, in the last 7 months alone, audits on 2019 tax returns have doubled for nearly every tax bracket. But the audit numbers might actually be higher in reality because, according to the IRS, the numbers are merely a snapshot in time and will change as more audits are completed and new audits are started. As we saw in the chart, all income earners are audited, even though the IRS likes to highlight high income earners. So, what can you do to avoid audits no matter your income level? Here's what you do. You avoid audit red flags, like not reporting all income. You see, the most common audit red flag is not reporting 100% of your taxable income. And this red flag is easier to catch than you think. You see, you often get a W-2 or a 1099 as proof of income when you perform work for another company. That's personal and as a business. And guess what? The IRS also receives a W-2 or 1099 confirming the money you receive. So you're not alone. And it will raise a red flag if there's a discrepancy between the income you disclose and the income indicated on your 1099s and W-2s. So report all income you receive, regardless of how little, to avoid any problems. And these include things you would typically not consider, like dividend income or cash back benefits from your credit cards. A second red flag is overstating your credits and your deductions. You see, audits are triggered by something called a discriminant function test, or DIF test. And this discriminant function test compares the deductions and credits that you claim to similar returns, and then rates your return for the potential of unreported income. To put it simply, the IRS has a gauge for the average number of credits and deductions claimed at each income level. And when the deductions and credits you take don't look natural, your return will be flagged and looked at a bit more closely. So go ahead and claim all the tax deductions and credits you are allowed to. Just maintain accurate records to support them. Number 3 on my list of audit red flags is simply having a large income. The truth is that when your income grows, your chances of getting audited also grows. And the IRS wants you to know it. You see, if we take a closer look at the About Us section on the IRS's website, we can find an article from the IRS with the title, IRS Audit Rates Significantly Increase as Income Rises. So let's look at some numbers to support this. As we saw earlier, audit rates for categories between 500,000 and 1 million doubled to 0.6%. Audit rates for the 1 million to 5 million category more than doubled to 1.3%. And taxpayers earning more than $10 million jumped 4 times, reaching a whopping 8%. So it's clear that returns reporting higher incomes are looked at a bit more closely by the IRS, as their ability to benefit from large deductions and large credits also increases. All right, number 5 on the list is reporting cash transactions. Look, Dave Ramsey isn't gonna like this one too much, but performing cash transactions can raise an IRS red flag. That's right. And you might not know this, but any business or trade that receives cash transactions over $10,000 must report the transaction to the IRS via Form 8300. In addition, financial institutions report on suspicious activities and attempts to avoid transaction rules set by the IRS. And this level of scrutiny by the IRS is a result of them attempting to crack down on money laundering. So if you deal in large transactions via cash, whether via business or personally, be sure to keep good records of your income. All right, number 6, deducting losses from a hobby. The truth is that most businesses won't be profitable from the start, but if you report multi-year losses from a business that the IRS deems a hobby, you will raise a red flag, especially if you receive large amounts of income from other sources. And according to the IRS, to deduct losses, your business must operate like a business and expect to make profit. But what does this really mean? Well, here's a general guideline. If a business reports a profit for 3 out of the last 5 years, the IRS assumes that that is a business that expects to make profit. On the off chance that the business reports a loss in more than 2 out of 5 years, the IRS is liable to assume that that business is a hobby. And that's pretty harsh, right? Well, here's some good news. Say you don't meet the 3 out of 5 year qualification. Other factors may help your case in classifying your business as an actual business, such as large amounts of time put into the business and reasonable startup costs for that type of business. And number 7, claiming large losses from gambling. Look, I like to play poker, but one thing I wouldn't gamble with is the IRS. All jokes aside, the IRS pays heavy attention to losses claimed from gambling. And this is because you can only deduct gambling losses to the extent you report gambling profits. So if you gamble recreationally and claim losses, the IRS will be looking to see if you also report your winnings and your income. And if you claim that you gamble professionally, the IRS is looking to confirm you actually gamble for a living. And whether it's recreational or professionally, be sure to report all income you receive from winning, as many casinos report your winnings to the IRS anyway. Now, I'm gonna place a few videos on the screen I think you should watch next. But before you go, please like this video as it helps our channel grow tremendously. And share some thoughts in the comments. Also, don't forget to subscribe to the channel so you don't miss out on other videos we put out to help you reduce your tax liability. I'm Karan from Life Accounting, and I'll see you in the next video.